Have you ever wondered what makes an investor successful? In the world of investments, success isn't governed by chance, but by intelligent decisions, and that's what we're here to delve into today. We're going to explore the essence of a remarkable book that's been illuminating the path of investors for decades, The Intelligent Investor by Benjamin Graham. This book, my friends, isn't merely a collection of pages, it's a treasure trove of wisdom, a guide to the world of value investing, penned by the mentor of Warren Buffett himself. The Intelligent Investor is not just a book, it's a legacy. It's the roadmap to investing success, revered by many as the best book on investing ever written. Why, you ask? Well, it's because this book doesn't teach you to follow the crowd. It teaches you to think, to analyze, to make informed decisions. So, are you ready to embrace this journey of learning? Stay tuned to learn how to become an intelligent investor. Or what if I told you that investing isn't just about following the crowd? Yes, you heard it right. There's a less traveled road in the world of investing known as value investing, a concept that takes a different approach, one that doesn't revolve around trends or popular opinion. Value investing, as the name suggests, is all about finding value, intrinsic value to be precise. It's about hunting for stocks that are undervalued by the market. It's like searching for hidden gems in a marketplace crowded with glittering but overpriced jewels. In his seminal work, The Intelligent Investor, Benjamin Graham, the father of value investing, emphasizes the importance of purchasing stocks below their intrinsic value. He firmly believed that the price of a stock often does not reflect its true worth. Market sentiments, economic trends, and various other factors can cause a stock's price to fluctuate. However, a keen eye for intrinsic value can help you identify stocks that are priced less than what they're genuinely worth. But how does value investing differ from other types of investing? Well, where growth investing focuses on the future potential of a company, value investing is more concerned with the present. It's about identifying companies that are currently undervalued, not those that might grow in the future. Moreover, unlike momentum investing, which is about riding the wave of a stock's recent price trend, value investing is about swimming against the current. It's about finding stocks that have been overlooked or misunderstood by the market. So, why is value investing important? Because it provides an opportunity for substantial returns. When the market finally recognizes the true value of the undervalued stocks you've invested in, you stand to gain a significant profit. But remember, value investing requires patience, thorough research, and a clear understanding of a company's fundamentals. Remember, the market is there to serve you, not to instruct you. So, don't be swayed by market trends or popular opinion. Instead, look for value. Look for opportunities where others see none. That's the essence of value investing. Scene script. Ever heard of Mr. Market? No, it's not a supermarket. Let's dive into a delightful metaphor coined by Benjamin Graham, the father of value investing. He conjured up a character named Mr. Market to help explain his fundamental investing principles. Picture Mr. Market as your obliging business partner in a private enterprise. Every day he tells you what he thinks your interest in the business is worth. Now Mr. Market has a peculiar behavior. Some days he is overly optimistic and his price seems high compared to the business's prospects. Other days he's down in the dumps and his price seems ridiculously low. The thing to remember is that Mr. Market's mood swings are more about him than about the underlying value of the business. This is where the concept of market fluctuations comes into play. The stock market, like Mr. Market, swings between optimism and pessimism. Prices rise and fall based on a multitude of factors, many of which have nothing to do with the intrinsic value of the companies being traded. So, how should an intelligent investor react to Mr. Market's daily communications? Well, the answer is simple. Use Mr. Market to your advantage. If he offers a very high price for your interest, you may consider selling to him. On the other hand, if he quotes a ridiculously low price, you should buy from him. However, if the price he quotes is satisfactory, hold on to your interest. The key is not to be swayed by Mr. Market's erratic behavior. It's easy to get carried away by the euphoria of rising prices or the despair of falling ones. But remember, as an investor, your focus should be on the actual value of your investments rather than the price at which they are currently trading. And there you have it, the essence of understanding Mr. Market and market fluctuations. Mr. Market's manic depressive nature can be a source of opportunity if you keep your emotions in check and make decisions based on rational assessments of value. Mr. Market is there to serve you, not to guide you. How would you like to have a safety net in your investments? Imagine walking on a tightrope. The higher you are, the more dangerous it becomes. But if you have a safety net below you, the fall isn't so scary, right? This is the same concept Benjamin Graham introduces in his book, The Intelligent Investor, known as the margin of safety. The margin of safety is the difference between the intrinsic value of a stock and its market price. In simpler terms, it's like buying a dollar bill for 80 cents. This gap, this margin, acts as your safety net, protecting you from market fluctuations and unexpected downturns. Graham suggests that the larger the margin, the safer your investment is. It's like having a wide and sturdy safety net as you walk that financial tightrope. The margin of safety provides a cushion against the impact of mistakes, miscalculations, and unforeseen events. Now, you might ask, how do we calculate this margin of safety? Simply put, it's by thoroughly analyzing and understanding the value of a company beyond just its current stock price. It's about looking at its financial health, its assets, its earnings, and its future prospects. However, it's important to remember that the margin of safety is not a guarantee against loss. Rather, it's a strategy to reduce the risk of loss. It's about making calculated decisions and not just betting on the whims of the market. In the world of investing, uncertainties are a given. Market trends shift, economies fluctuate, businesses rise and fall. In such a volatile environment, having a margin of safety can be the difference between a devastating loss and a manageable setback. So, as you navigate through your investment journey, remember to incorporate this principle. Look for stocks with a substantial margin of safety and make sure you're not just buying into the hype. Be analytical, be patient, and always be prepared for the unexpected. A good investor always keeps a margin of safety. It's your buffer against the uncertainties of the future. Are you a defensive or an enterprising investor? In Benjamin Graham's world of intelligent investing, investors fall into one of these two categories: defensive and enterprising. The difference between them lies not in the amount of money they have, but in the amount of time, energy, and knowledge they are willing to devote to their investments. Let's start with the defensive investor. This type of investor seeks safety plus adequate return. They are not interested in spending a lot of time researching and analyzing investments. Instead, they want a solid, reliable strategy that protects their principal and generates a decent return. Graham recommends a diversified portfolio of high-grade bonds and leading common stocks for the defensive investor. He also suggests that they should split their portfolio equally between stocks and bonds to maintain a balance between safety and returns. On the other hand, an enterprising investor is willing to dedicate time and effort to manage their investments actively. They are not afraid to tread the less traveled path, hunting for undervalued stocks or bonds that the market has overlooked. For these individuals, Graham suggests a more dynamic approach. They should look for low-cost, out-of-favor securities that have a strong likelihood of appreciating in value. However, this strategy requires a higher level of knowledge and a greater willingness to take risks. But remember, being an enterprising investor doesn't mean you throw caution to the wind. Graham insists that even enterprising investors must adhere to the fundamental principles of investing, such as insisting on a margin of safety and being alert to market fluctuations. So, whether you're a time-strapped professional looking for a hands-off investment strategy or a savvy investor willing to roll up your sleeves and dive deep into the world of investing, Graham's wisdom has something for you. The key is to understand your investment personality and choose a strategy that aligns with your resources, goals, and risk tolerance. Whether you're a defensive or an enterprising investor, Graham has a strategy for you. So, are you ready to become an intelligent investor? As we've explored throughout this discussion, the principles of intelligent investing are rooted in discipline and patience. We've delved into the heart of value investing, understanding that it's not merely about buying stocks, but investing in businesses at a price below their intrinsic value. We've met the enigmatic Mr. Market, whose mood swings teach us about the irrationality of market fluctuations and the opportunity to buy low and sell high. We've also learned about the concept of the margin of safety, which shields us from the unforeseeable errors in our investment calculations. we've distinguished between the defensive and enterprising investor, emphasizing that the choice between the two depends largely on one's time, interest, and knowledge in managing investments. In conclusion, remember the core essence of Graham's philosophy. Investing is not a game of luck or chance, but a game of discipline, patience, and understanding. Remember, investing isn't just about making money. It's about understanding the value and making intelligent decisions.